Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It is great to be back. And, looking at the calendar, it's late January 2026. I think started is definitely the right word. It feels like the year just really kicked into gear this week.
You are not kidding. I mean, if you've been watching the news or, heaven forbid, looking at your 401k, you're probably feeling a little bit of whiplash. We have the US dollar acting like a yo-yo, and then we have the tech world trying to, replace human hands with robot cursors. It's been a lot.
It has. It's one of those weeks where the big picture, the macroeconomy, the money in our pockets,
Right.
and the small picture, the microeconomy, the tools on our desks, they're both screaming for attention at the same time.
And they usually feel so separate.
They do, but right now, they're both hitting these major inflection points.
So here's the mission for this deep dive. We're going to try and cut through some of that noise and look at three specific things. First, the U.S. economy. But I don't want to just talk about debt. I want to know why everyone is suddenly so obsessed with this idea of a trust premium.
That is the key phrase.
Yeah.
You're right. The debt number is huge, but it's the trust in our ability to pay it that's become, the really volatile variable right now.
Second, we have to look at this weak dollar experiment that we just saw play out. We had comments from President Trump, then this quick damage control from Treasury Secretary Bessent. It was confusing.
It was a communication breakdown, plain and simple. And, as we'll get into, confusion is expensive in financial markets.
Very expensive. And finally, we're pivoting to tech. And no, not just another chatbot. We are talking about MultBot and the rise of these AI agents.
Yeah.
Apparently, the traditional way we pay for software subscriptions, SaaS, that whole model might be dying because of them.
It's a massive, massive shift.
Yeah.
We're moving from software that just talks to you to software that actually does the work for you. And that changes the entire business model of Silicon Valley.
All right, let's get into it. I want to start with that big, scary number. According to the Treasury's latest data, as of January 28th, the total U.S. federal debt is sitting at roughly $38.54 trillion.
It is a staggering number. It's hard to even get your head around.
It is.
I mean, to put that in perspective, if you spent $1 million every single day since the year zero, you wouldn't even be close to $1 trillion yet. And we have nearly 39 of them.
That hurts my brain.
Yeah.
But, okay, here's where I get stuck. We've been hearing about record debt for decades. It feels like every year it's a new record. Why does this number 38 trillion suddenly matter so much more?
It's less about the specific number and more about the context around it. Think about it like a credit card.
Okay.
Usually we focus on the total balance, right? Oh, you owe $50,000. That sounds bad. But what if you have a great job and you always pay on time? The bank doesn't really care.
They just keep raising my limit.
They keep raising your limit. Exactly. They know you're good for it.
Yeah.
But what if you start acting, erratic? What if you threaten to quit your job to make some kind of political point? Or you tell the bank, maybe I'll pay you, maybe I won't. Kind of depends on my mood.
Suddenly the $50,000 isn't the main problem.
No. The main problem is your character. They stop trusting you.
And when they stop trusting you?
They see you as high risk. So they jack up your interest rate to cover that risk. They start saying, well, if I'm going to lend you another $20, I need $10 back in interest just in case you decide to run away.
Okay, I see where you're going. That extra interest, that cost of doing business with a crazy person.
Yeah.
That's the trust premium.
Precisely. And right now, the U.S. government is kind of acting like that chaotic friend. The real catalyst has been this constant fiscal uncertainty. I mean, remember back in late 2025, just a few months ago, we had that record-breaking 43-day government shutdown.
Oh, I do. It felt like it went on forever. It was exhausting. National parks closing, paychecks stopped. It was a mess.
It was incredibly damaging.
Yeah.
And the damage wasn't just, closed parks. It was reputational. And even now, late January 2026, we just dodged another shutdown scare.
Right.
The deal was just announced, but the damage is cumulative.
So you're saying the markets are looking at Washington, D.C. and basically saying, we don't trust you guys to keep the lights on.
Yes. The data shows the dollar is reacting more to this political drama, these budget fights, than to normal economic logic. Investors don't care if the underlying business, the U.S. economy, is strong. They care if the management team is fighting in the parking lot.
That's a great image. And speaking of fighting in the parking lot, let's talk about the communication coming out of the White House. This whole weak dollar thing this week was Messy.
Messy is a very polite way to put it. It was a classic example of mixed signals, which is the last thing you want when you're managing the world's reserve currency.
So walk us through the timeline. On January 27th, President Trump made some comments.
Right. He made some remarks that the market interpreted as him favoring a weak dollar. Now, on paper, there is a logic there.
Okay.
A cheaper dollar makes American goods cheaper for foreigners to buy.
Yeah.
So if you're a company like Boeing or Ford, a weak dollar can help you export more. Your products basically go on sale for the rest of the world.
Right, so that just sounds like a strategy. Let's make our stuff cheap so people buy it. Why did the market freak out?
Because there's a huge difference between a managed, gradual decline and a crash. The dollar hit a 4-year low almost immediately after those comments.
Wow.
And the problem is, while a weak dollar helps exports, a crashing dollar destroys the value of U.S. assets for everyone who holds them.
So if you're a foreign investor holding U.S. bonds,
And the dollar drops 5% overnight, you just lost 5% of your money in real terms. You're not happy.
so everyone just ran for the exits.
They started to. It looked like a panic sell, which is why the very next day, January 28th, Treasury Secretary Scott Bessent had to step in. He had to play firefighter and reaffirm a strong dollar policy just to calm everyone down.
It feels a little bit like a disorganized household. One parent says, hey kids, eat whatever you want, ice cream for dinner.
Yeah.
And then 5 minutes later, the other parent runs in screaming, no, eat your vegetables, we are a healthy family.
That is a perfect analogy.
Mm-hmm.
The kids, in this case global investors, they're just sitting there confused looking at the ice cream and the broccoli, and they don't know what to put on their plates.
And confusion is expensive.
In finance, confusion is very expensive. When investors are confused, they charge you for it. They demand a higher premium to hold our debt. They basically need to be paid to tolerate the chaos.
Which brings us to the people who are actually holding that debt. Because we owe $38 trillion and we aren't borrowing it all from ourselves. Who's actually buying this stuff?
That is the $38 trillion question. If we look at the data from November 2025, which is the latest verified breakdown we have, foreign ownership of U.S. debt actually hit a record high, about $9.35 trillion.
Wait, hold on. If it's a record high, why are we worried? That sounds like the world still loves our debt.
The total number is high, yes. But you have to look under the hood. The guest list at the dinner party has changed dramatically.
Who's out and who's in?
Well, China is buying less. That's a long-term trend we've seen for a while now. They're slowly reducing their exposure. But Japan and the UK are buying significantly more. They're the ones picking up the slack.
Okay, so we just swapped one lender for another. Is that really a problem? Japan and the UK are allies?
It works for now,
Yeah.
but it makes us incredibly reliant on the psychology of those specific allies. It concentrates our risk.
I see.
And frankly, European regulators are getting pretty nervous about how we're behaving.
Nervous how?
There was a warning that came out recently from BaFin, that's Germany's financial regulator. They're watching this closely. And they warned that if the U.S. plays games with the dollar, tries to artificially weaken it for trade, it could break the global financial plumbing.
Financial plumbing, that sounds essential. Like it's something you definitely don't want to clog.
It is essential. European banks, for example, rely heavily on short-term dollar funding to just operate day to day. If the U.S. loses what they call policy credibility,
Your trust.
the trust, and foreign investors lose that trust, they stop buying our debt. If they stop buying, the interest rates, the yields on our debt have to go up.
Okay, so connect that to the listener. Why does a German regulator caring about plumbing matter to someone who just wants to buy a house in Ohio?
Because U.S. Treasury yields set the baseline for pretty much everything else in our economy. If the government have to pay more to borrow, you pay more for your mortgage, you pay more for your car loan, you pay more for your credit card interest, it all goes up.
So if Washington plays politics with the dollar, my house gets more expensive.
Precisely. The big takeaway for 2026 is that we all need to watch policy credibility as a major risk factor. It's separate from just normal economic data like inflation or jobs. It's about whether the world believes we are, the adults in the room.
Man. Okay, so the economy is all about trust right now. Let's pivot completely. Because while the dollar was bouncing all over the place, something huge happened in the tech world this week.
Yes,
And it's also about trust, but in a totally different way. We need to talk about Moltbot.
we do. And the rise of agents.
Moltbot, it sounds like a villain in a Transformers movie.
It's close. It was actually called Claudebot until, yesterday. Got rebranded around January 30th. But the name isn't the important part. The functionality is what matters.
So what is it? Is it just another chat GPT that I can talk to? Because honestly, I'm getting a little bit of AI fatigue.
I get that. I
Okay.
really do.
Yeah.
But this is different. We are moving from chatbots to agents. This is a distinct evolutionary step.
Okay, break that down for me. What is the actual difference?
A chatbot, like ChatGPT, it generates text. You ask a question, it gives you an answer. It's passive. It just sits there and waits for you.
Right.
An agent, like Moltbot, it executes labor. It controls your computer. It uses your mouse, your keyboard, your browser to actually do things.
Whoa. Wait, so it's not just typing back to me, it is taking over my screen.
Yes. Think of the old AI, the chatbots, like a GPS. A GPS is great. It tells you exactly where to go. Turn left in 500 feet.
But I still have to drive the car.
You still have to drive the car. You have to turn a wheel. You have to watch the road. You're doing the manual labor. You're just getting advice.
Right.
Moldbot and these new agents are like a self-driving car. You don't drive. You just say, take me to the store. And the car moves the wheel, hits the gas, and parks itself. It takes the mouse out of your hand.
That is both amazing and terrifying.
It is a bit of both. And it's not just some random open source project. The whole industry shifted this week. Anthropic released their computer use tools. OpenAI released something called Operator. Even Google Chrome is adding an auto browse feature.
So my browser can just go buy my groceries while I'm sleeping.
Theoretically, yes. The big implication is that AI is moving from just generating text to executing labor. But, as you hinted, there's a huge catch.
The security, right. If this thing controls my mouse, can't it just, I don't know, Venmo all my money to someone?
That is the security nightmare everyone is talking about. We call it prompt injection. If a hacker can trick the AI, they're not just getting it to say a bad word anymore, they're getting it to click transfer funds.
Yikes. It's one thing if ChatGPT writes a bad poem. It's another thing if it deletes my entire hard drive.
Exactly. So we're about to see a whole new industry of agent security. Auditing these robots is going to be big business. But there is another victim in this shift, and this is where it hits the stock market.
I saw the software stocks took a dive. Companies like SAP, ServiceNow, usually the boring, stable ones.
Yes. Around January 29th and 30th, we saw major volatility there.
Yeah.
And it's directly related to these robots. It has to do with the business model we call SaaS.
SaaS, pronounced SaaS, right?
Correct. Software as a service. For the last 20 years or so, that business model has been based on seats.
Beats, like physical chairs in an office.
Metaphorical chairs. If you run a company, you buy a subscription to Salesforce for every employee. 100 employees means you buy 100 seats or licenses. You pay per human head.
Okay, that makes sense. More people, more money for the software company.
But here's the problem. If AI agents like Moltbot start doing the work, do you need 100 humans?
No. Maybe you only need like 10 humans just to manage the robots.
Exactly. And if you only have 10 humans, you only buy 10 seats.
Oh, I see. So the software company's revenue just falls off a cliff?
Right? Think of it like a gym membership. The gym makes money because people sign up. But if you stop going to the gym yourself and you just send a robot to lift weights for you.
Why would I pay for a membership for the robot?
Exactly. The robot doesn't care about the sauna or the pretty locker room. It doesn't need a user interface.
That's a fantastic way to put it. It doesn't need pretty buttons.
It doesn't have eyes. And that is why the seat model is dying. Because the robots are taking all the seats.
But these huge companies can't just go broke. Microsoft isn't just going to pack up and leave. How do they survive?
They're changing the model. We're seeing the rise of what's called outcome pricing or action pricing.
What does that look like on my bill?
Instead of charging per person, they charge per job done. Salesforce is starting to charge for action credits. Microsoft Copilot is charging for agent steps. So if the AI sends 1,000 emails for you, you pay for 1,000 actions.
Interesting. So they're not selling me a tool anymore. They're selling me a result.
Exactly. And this creates very clear winners and losers in the stock market for 2026.
Okay, walk me through the losers first.
The losers are the companies whose whole value is just a pretty screen, a nice UI. Agents don't need that. They read code. So if your entire business is, our app looks nice for humans, you are in a lot of trouble.
And the winners?
Infrastructure, chips, memory. Because these agents work 24/7, they never sleep, they need massive computing power. And also what we call systems of record, the places where the data actually lives. The agents have to pull the data from somewhere.
So that on the plumbing and the electricity, not the pretty paint on the walls.
That is a very sound strategy for this year.
Okay, let's zoom out and try to tie this all together. We have the U.S. debt, the confused dollar, and now the robot revolution. How do these dots connect for the listener?
Well, I think if we look at the big picture, we were in this very fragile moment of transition. On the economic side, trust has become the most expensive commodity out there.
Hmm.
The government is learning you can't just print credibility. The dollar is swinging based on political headlines. That trust premium is very real, and it's pricing in the chaos.
And on the tech side of things.
On the tech side, we are shifting from human-centric software to agent-centric work.
Mm.
We're not building tools for people to click anymore. We're building systems for robots to execute. And that changes how every software company makes money.
It feels like the rules of the game are changing in both of these huge arenas at the exact same time. It's really disorienting.
It is, and I think it raises a really important question for everyone listening to sort of mull over.
What's that?
As these AI agents start doing more actual work-driving efficiency through the roof, cutting costs, removing humans from the loop, and at the same time, the U.S. government is navigating this debt crisis, are we valuing efficiency in our tech while we're risking stability in our economy?
That is the million-dollar question. Or I guess the $38 trillion question now. We're optimizing the micro while the macro gets shakier and shakier.
Indeed.
So for all of you listening, here is your homework. Watch the trust premium in the bond market. That's your new measure of political stability. And watch for action pricing in your software contracts. That's your measure of the AI takeover. Those seem to be the two new scorecards for 2026.
Couldn't have said it better myself. Keep your eye on the signal, not all the noise.
Thanks for listening to this deep dive. We hope you feel a little less confused about the wild week we just had. Don't forget to subscribe and hit that like button. We'll catch you next time.